I've always been big on, buying ETFs as investment vehicles, and that's not going to change even going into 2017. It's now December, it's the last month. The market has pretty much recovered from, Brexit and whatnot. There is this weekend a vote in Italy on changing the constitution, and a no vote probably will drag the markets down, present another buying opportunity. As we see, the EU start to crumble more and more. But the European countries in themselves are, stable and strong, and in the long run, they will be great. So I want to make this video going into 2017. We also have interest rates about to rise. So there's going to be opportunity in 2017. Wherever there is chaos, there is opportunity. If you wait for the smoke to clear, it's going to be too late for you to get in. I've held over the last 10 years pretty much, the same type of ETFs, and I want to go over with you some that I think are great that will be available for you in 2017 to make a long-term investment in and to really capitalize on, and to really get a good deal on at this point in time. The first one is VNQ. VNQ is Vanguard's REIT ETF. It's real estate investment trusts. What I like about it is not only over the last 10 years have I, with this type of ETF, been able to get great returns, but I've been getting about 4% in dividends per year, and those 4% are being reinvested right back into the ETF. And when you look at that, if your brokerage has a dividend reinvestment plan, and you're going to go back and look up historic returns, when you actually reinvest the dividends instead of just getting the check and putting it in your pocket, you end up over a 10-15 year period with about 50% more in gains. So your 10% average return per year can turn to 15% or even more, just because right off the bat, when you start buying, and especially if you're doing this in an incremental fashion where you're going in every couple of weeks and buying more, you get not only a great average price, but you're getting also those dividends right back in at 4% a year. And right from the first quarter, when you receive that dividend, those dividends start to earn income as well. So dividend reinvesting plans is something you really want to do with these ETFs. Real estate, over time is a real asset. These companies that hold a lot of real estate are going to always do well in the long run. There is a limited supply of real estate. It's not like other companies that can just turn up production of whatever it is they sell in order to meet the market demand. We live in a world with a growing population. Especially in the United States, we have a growing population, and there's really, a limited supply of real estate. So the VNQ is something you need to hold on to. I've, been making about 10% a year with the dividend reinvestment plan over the last 10 years, and that includes the real estate crash. So holding it through the crash, really, it recovered within a year's time, and after that it's just been gain after gain after gain after gain. Rising interest rates now may reduce the value of some real estate, because people that go out to buy real estate need to pay more for their mortgage, and what that does is drive prices of houses down, because for the same amount that you would be paying on your mortgage, you can afford less of a less expensive home, just because you're paying more in interest as a part of that mortgage. So VNQ is something I'm holding on to for dear life. Real estate has historically been a great producing asset, and it always will be. And so you could bet in the long term, 10-15 years from now, you'll be doing that. And having ETF as a part of having real estate ETF as a part of a well-diversified portfolio can really help you in times where other markets like financial markets are not doing as well. So the first one you want to look at, is the real estate. The second one is VYM. VYM is Vanguard's high yield dividend stock. This I actually have two Vanguard dividend ETFs that specifically go out to find these companies that for over 10 years have been consistently increasing their dividends. One is VYM. VYM is my favorite of the two because it's grown for me much more than the standard dividend appreciation ETF. It's the high dividend yield ETF, and it's just been giving me phenomenal returns over the last 10 years, which includes 2008. Having a high dividend yield ETFs in my portfolio has returned for me about 14 to 15% a year. And the way I get that done is by the dividend reinvestment plan. Those dividends are being reinvested back in. So you're accumulating shares as you go along. Your shares are actually gaining interest on them. So if you buy 100 shares and you get 4% a year, that's 4 more shares that you can buy. And because those dividend payments are split up quarterly, you're getting 1 additional share every quarter, and that's producing more income for you. And these companies that are paying high dividends are usually stable, big American companies, Johnson & Johnson, Microsoft. They're not companies that are going anywhere. And this is, this ETF in particular has the highest rating among, Morningstar and other places that rank ETFs. It's just really a fantastic ETF to own. The accumulation of shares with high dividend, this one returns about 3% annually. It doesn't give you as much dividend as real estate does, but it does have a lot of upside opportunity in terms of market appreciation, maybe a little bit more than real estate does. Real estate pays you those very high dividends, but real estate doesn't grow as quickly. You need to reinvest those dividends and in real estate to really get benefit of those returns. If you really want to get 8-10% a year on average. With VYM, I mean, it's been something like 14% for me, and going in, even if the market makes a big correction, that doesn't bother me because I'm up so much on it, and I still have 15 or 20 years left to go in my target date for these investments. So go out and buy, in 2017, pick up some, especially if the market dips. If the market dips, it will be a great opportunity for you to pick some up cheap. You'll still be getting those high dividends. Just because the market dips doesn't mean that, these companies are going to start cutting dividends. They've had for 10 years increased dividends, which means even when the market dropped in 2008, they still kept increasing their dividends, these companies. So you want to own these companies. You want to own high dividend stocks. You want your capital to appreciate. You want the amount of shares you own to appreciate. You don't just want to get the dividend check and put it in your pocket, unless that's a part of your strategy. And if that is, all the power to you. I know a lot of investors who use their dividend income as actual income. They pay bills with it. But you're paying such a low fee with these ETFs in terms of management that every cent you get that's going back in is great. You're paying a fraction of 1% as opposed to what you're paying in your 401k plan, which is 1.5%, sometimes 2%. That really eats into your profits and into your ability to compound the interest that you're making, and for that to really in the long run do you some good. The next one that we want to look at, which has also been great for me, is VUG. These are the growth Vanguard fund, and it focuses on stocks that are in growth industries as opposed to value stocks, which are, value stocks are not as risky. They're not as volatile as growth stocks, but they don't have the ability to return the same amount to you at the end of the day, simply because these value stocks are very well established stocks, and they have their place in every portfolio, especially if your portfolio is prone to have big swings. Then you want to get things like bonds, and you want to get things like value stocks, simply because these are big companies, electric companies, telecommunications companies. These are companies that offer services that most people use day to day. Everybody that has electric in their house. Everyone you know has gas. Everyone you know is using a cell phone. So those value companies are something you want to hold on to, simply because those are established. When you look at the growth, the VUG, there's more upside potential. So if you're holding for 15, 20 years, just look at what tech has done over the last 15 to 20 years compared to your electrical power companies. It's grown exponentially more, and you want to take advantage of that, because if what we've seen over the last 20 years in terms of development of the internet and development of cellular phones and computers and all the technology that we use, the increase in our life is not going to slow down anytime soon. It's going to actually increase. We're just going to become more and more technologically oriented. You see every kid now walking around with an iPhone. They're learning at a young age, and they're going to be more tech savvy, and those consumers that are growing up now are going to demand more and more tech products to kind of make their life simpler, to make things easier for them. They're growing up with it, so it's going to be a big part of their lives, more so than the current generation and baby boomers. We're going to be entering in the next 20 years a phase where even the eldest Americans have utilized technology to some extent on a day-to-day basis, with computers, with laptops, with mobile phones. It's not the same thing as those that are 80 and 90 now going into 2017. So those are three great picks that I have for 2017 for those of you that are looking for long-term investing. We don't know exactly what's going to happen. The next few weeks is going to determine a lot. If we get poor results from these votes in Europe, what that's going to do is shake the markets a little bit, shake some people out. But you have to look at it from a long-term perspective. From a long-term perspective, you kind of want to look at this as pump and dumps. These markets will go up. The big whales will shake people out when there's lower prices, drive prices even lower to try to shake you out, so that they can pick up all these ETFs and all these stocks for cheap. And you just have to have the will to hold through it. You have to think about it in terms of at least a 5-year minimum investment period. You can't think about it in terms of making a quick buck or picking winners and losers. When you buy ETFs like these, they're very well diversified. So if any one company in there really takes a hit, or a handful of companies, you're always going to have companies that do well at the same time. Even when the market, crumbles, it's not every stock that drops to that extent. There's still going to be some that perform better than others, and on the upside that goes as well. So ETFs are a great way for the average Joe, or for someone that is supplementing their business, or someone that doesn't want to focus too much, like someone that's investing in a 401k or something like that. Those fees will kill you. And if you're very passively investing, you need to understand that these ETFs are also actively managed. They have turnover. Sometimes stocks are taken off. If you're following an index like an S&P 500, like the VOO, for instance, that's Vanguard's large cap, basically S&P 500 index, the ability for you to just set it and forget it is better than any type of actively managed fund, because that's what these funds are tracking. And to begin with, they're tracking indexes. The indexes go up over time. The one thing I want to tell you is that 20 years from now, we don't know what's going to happen. We don't know what's going to happen tomorrow. Anyone that tells you they can predict the future in the stock market is, just blowing smoke. The one thing we do know for sure is that your dollar is going to be worth a lot less in 10 years from now, in 20 years from now. The purchasing power will be less. There will be inflation. Prices of things go up. If you think about your lifetime, the only one thing that you've been able to guarantee in your lifetime is that your dollar will buy you less tomorrow than it does today. And that's just because the monetary system that we have is designed off that. It's designed to create inflation. Inflation is the target of our central bank. It's the target of, economists. Everyone wants inflation because inflation is a sign that people are spending, that the economy is growing. When you have deflation, it's a sign of a contracting economy. It's a sign that people are saving money. When prices drop, it's usually because, there's an abundance of supply or there's a lack of demand. And for you personally, all you can bet on is that there's going to be inflation, and betting on indexes, betting on these ETFs that are very well diversified, that are, have a very good history of returning money to you over the long run. Those are the best things you can do. There's so many ETFs out there that you can get. Even if you think chaos is, if you think like many people do, like Austrian economists, and you can subscribe to that perspective over the long term. Is the dollar going to be sustainable? Are we going to hit at some point runaway inflation? Nobody knows. Nobody knows what's going to happen. Nobody knows if the dollar will be dumped as the global currency. The petrodollar is on its way out. No one knows if gold is going to replace the petrodollar at some point. You don't know, but with ETFs, you can hedge your bets. You can hedge your bets with things like gold and silver, and you could pick up little bits and pieces of these just in case, the market it shakes out and we do have economic turmoil, that your portfolio is protected. I say that it's possible. Is it likely? In my opinion, no, it's not very likely that in our lifetime, at least, the dollar is going to collapse. I think that other countries are doing, their people a much bigger disservice, like China and places like that, with the devaluation. And if you think that's going to happen in the U.S., probably the best place to be is in the financial markets, because when there's inflation like that, and when your dollar keeps buying you less and less and less, the value of these stocks go up and up and up and up and up. It's just like food. When the value of your dollar goes down, it buys you, it's less food that you buy. Each dollar will buy you a slice of pizza every year or so. Or buy you less and less of a slice of pizza, from 1/8 of a pie to 1/16 of a pie. So your money is going to buy you less and less stocks over time. If you put them in now, then you'll be able to participate in that growth. If we do have hyperinflation, that's actually good for financial markets, just because hyperinflation pretty much means that prices are skyrocketing. And if prices are skyrocketing, the prices of stocks and things of that nature skyrocket as well. Over the long term, you need to get invested in ETFs. 2017, those are 3 ETFs that you really want to pick up on, especially if there's a market correction. You should focus on investing now for the long term. You should buy the real estate VNQ. You should buy the VYM, the high dividend yield, and you should also look at the growth companies like technology, which, tech stocks have been taking a beating for the last year. Donald Trump's coming in. No one knows, what's going to go on with the manufacturing, with companies like Apple and things like that. So the stocks are overall down, but they have massive upside potential. And any market correction will be, you'd be doing yourself a huge disservice in 2017 if you were not to capitalize on that.